Our next guest says relative valuation, equity risk premium, for example, is still attractive under the current market environment. Let's bring in Kelly Chung. She's Senior Fund Manager for Multi-Assets at Value Partners. Kelly, thanks for joining us. What do you mean by that exactly?
Hi, good morning. So I think the Asian market is definitely still doing well compared to the rest of the world. Asia is especially China, is the first one that has gone through the pandemic, and they have come out pretty well. And the data so far has shown a still pretty strong recovery. Although the pace of the recovery may slow down a bit, but the recovery is still pretty strong. So we believe that it will continue to last at least until the end of the year. So for the overall equity market, although from absolute term perspective is pretty expensive, but we are now so-called in a new normal environment where interest rate will stay low for a prolonged period of time, and central banks are still pouring liquidity into the market to support the economies. So I think we have to look at relative valuation in the current environment, which we have to compare, for example, equity risk premium, which is the equity yield versus bond yield. And from that perspective, the equity market is still pretty at a reasonable valuation level at the current environment.
Kelly, but, as this rally continues, we look at all the metrics and the various ways of valuing companies, and it does look like those valuations are getting rather extended on most measures. How extended and how concerned are you about it from that perspective?
Yes, as I said, if we look at from an absolute perspective, they are really extended. Like, no matter we look at PE, PB, those traditional valuation measures, and especially compared to history, they are pretty stretched. However, as I said, we are kind of in a new normal environment where interest rates will be zero or even negative for a prolonged period of time. So, and with the ample liquidity, people have no choice right now but to put money into risk assets. For example, individuals or even pensions, they have to, meet a certain income requirement or certain return requirement. They have no choice. They cannot put the money into the traditional fixed income history. So they have no choice but putting more into risk assets. So I think as long as the liquidity are still available and central banks are still doing whatever they can to support the economies, we have to look at relative valuation, and from that angle, we're not that crazy yet.
So it doesn't actually look that fragile at the moment, Kelly, but what could alter that? Is there a catalyst? Could it be in the political side of things as we head towards November the 3rd?
I think the biggest risk in the market right now is definitely political risk, because these cannot be predicted. So no matter the U.S.-China tensions or the U.S. election political risk, these are the biggest uncertainty in the market right now. However, definitely as we are getting closer to the U.S. election, if the Democrat pool continue to go up, definitely there will be more uncertainties because they have different policy going forward. So the market may take some correction. However, as I said, because there's so much liquidity in the market and people have no choice but to put money into risk assets, so I think the market is pretty hard to have a deep correction as long as the central banks are still stand by the economies.
Kelly, there is so much talk about a broadening of the rally. How convincing is that rotation away from tech?
Okay, yeah, there are a lot of talk about, comeback of value style, rotation of leadership from the growth tech sectors to the more value sectors. With the Fed already mentioned, they allow for flexible average inflation target. We believe that inflation will gradually come back in the next few years with the yield curve steepening. So that will favor value stocks. However, that will not be an immediate change because right now we are still in a recovery mode from a pretty hard-hit economy, and people are still looking for companies with sustainable growth. So they will still rather to pay high multiple to companies and sectors that still deliver very strong and sustainable growth. So I think in the near term, technology definitely is one of the growth sectors that have high visibility. So people will continue to pay for that. However, as we in the next few years, when inflation starts to get rising and the yield curve get more steepening, then I think there will be a bigger rotation back to value sectors, but may not be in the near term.
It does seem like the downward revisions, earnings revisions, has bottomed, but Asia has yet to play catch up when it comes to earnings revisions upwards. I mean, how do you play that?
Yeah, in the U.S., definitely earnings revision has already climbed quite significantly. They have significantly revised the earnings upward after the Q2 earnings and also the upbeat guidance from the companies. In Asia, it's actually also happening. Analysts are also revising up their earnings expectation. For MSCI Asia ex Japan, they already expect this year will have 8 to 10% earnings growth. So I think for Asia, as I said, they are actually recover faster because especially China is one of the first countries to come out from this pandemic. So I think the earnings growth will continue to be healthy in Asia, and analysts will continue to revise more upward. And also with the weak U.S. dollar trend, I think the capital will continue to flow back to emerging markets, especially Asia. It just started to happen because we just started to see inflow to emerging markets last week. But I think that will continue because the U.S. dollar will stay weak. It's a structural weakening trend, and people, in order to get return, they will come back to Asia. They will come back to emerging markets, especially Asia.